Principles of finance, a la Shmup. Appropriate debt ratios. So let's start out this little story asking why a company would take on debt in the first place. Well, let's say a company could buy a competitor who is struggling to survive for $20 million and put that competitor's product onto the company's sales and distribution platform, and in the first year of owning that target, take a company that was barely break even and in year one have profits of $8 million after, firing everyone from the competitor company that was just acquired. In year two, the company then makes $12 million in profit, basically earning back all of the money it borrowed to buy that competitor. Was that a good deal? Well, absolutely. And companies take on debt all the time to make what is called strategic accretive acquisitions, just like this. They borrow money to do the acquisition because, well, they probably didn't have the cash to begin with, and they didn't want to use their own stock because they didn't want to suffer dilution in the process. The debt capital allowed the company to expand and grow faster than it would have had it remained unleveraged. So that begs the question, how much debt can a company borrow? Like, what's the appropriate level, and how do you even think about that question? Well, let's start with some frames that paint out companies who can and maybe should borrow a lot of money and those who should not. All right, well, the truth is that economic cyclicality determines borrowing rationale. You've probably heard of the cycle, or at least the economic cycle, or at least cyclicality. None of those crickets? Okay, all right, let's go back. Well, most of the world's economies operate in regular mini boom and bust cycles. The stock market typically leads the cycle, or said the other way around, the economy lags the stock market. Why? Well, because stock market prognosticators, investors, and other gadflies spend all day staring at data and talking with other gadflies about what they all see in their crystal balls. Well, they're the canaries in the mine shaft, these gadflies. They try to look into the future because they get massively paid if they are accurate in their predictions by putting their investors' money where their mouths are. And they look for patterns. Well, roughly every 7 or 8 years, we tend to have a boom and a bust cycle. From 1981-82 to the late 80s, we had a big bull market, bull economy, and then the junk bond scandal kind of killed things for about 2 years. Market recovered. And then from late 1992 until late 99, early 2000, we had the greatest bull market in history. Thank you very much, Yahoo and all those people. Then things blew up for about 2 years, and the market bottomed late 2002 and kind of into 03, and then recovered into 07-08 when it blew up again big time in the mortgage crisis, which bottomed in mid-09, and well, then the market's been on a tear after that for a decade. Better check your calendar. Yeah. So any blip on the radar, from a bomb going off in the Middle East to a sign of fraud to a sign of structural weakness like the student loan crisis we're all nervous about these days, will send a mini panic to the people who invest in the stock market. They pull their money, the market falls until it reaches a level where growth investors have all left, all the optimists are gone, and the value investors have now stepped in because the fundamental risk-reward ratio, well, it looks favorable for $1 invested today, paying more than $1 in the next, year or change. So back to company debt levels. If you are a highly cyclical company, can you afford a lot of debt? No, absolutely not. If your only business is selling washing machines, you're going to have very few people upgrading in bad economies. They'll just repair their old ones and make them last 2 more years instead. In those bad years, it's likely you go from operating profits of 20% to operating losses of like 10%, meaning of revenues, something like that anyway. If you then stacked a bunch of debt on top of that, well, you'd risk bankruptcy in the bad times and be, well, pretty much dead, like gone, RIP. So that was washing machines. Highly cyclical business, cannot afford a lot of debt. But what about cable television? Well, most people in America would rather starve or at least live on ramen noodles than have their Game of Thrones and internet connectivity turned off, right? So in boom times, the cable industry, well, doesn't grow much faster than it does in bad times. It doesn't even wither. And the cable industry is a non-cyclical business and is appropriate for a lot of debt. And historically, yeah, the cable industry has taken on massive amounts of debt. So note the myriad strategic options that having access to debt capital affords companies. Lots of great reasons to have the option of a bunch of debt when the great opportunities arise. All right, well, if a company has lots of capital at its disposal, it can build better product, more efficient factories, tastier treats, quicker, better delivery to customers. It can also buy competitors, cut costs, and raise prices. Or saving any of those strategic options, it can take out debt to to just buy back its own stock. That way, when you want to scream at the idiot who's running the company, the one responsible for selling you the friggin' shares that you just bought back, well, yeah, then all you need to do is find a mirror. So, all debt is not bad. All right, well, what's an appropriate debt level? Well, there are really two drivers of appropriateness when it comes to debt levels, and both are framed in the revenue and margin structure of the company. All right, backing up, the general idea is that you have a lot of revenue and high margins, say $1 billion in cash profits each year. Well, then can you afford $1 billion of debt? Almost certainly. Can you afford $10 billion of debt? Well, almost certainly not.